Alright guys, so we're back with another one. It's a brand new week and we are switching up with this one because what I've noticed is out there on YouTube, everyone is far too euphoric about every stock in the market. We need to be far more critical about these stocks. That's going to allow you guys to be a lot more selective with what you add to your portfolios. Remember, we only want the best in class plays in our portfolios, only quality. We don't want any dead weights. So that being said, in this drop, I'm going to be tearing up a play with you guys, showing you how you analyze a stock. So get yourself ready for some savage Sankey, but it is needed so you're easily able to identify what is trash and what is treasure out there in the market. And I'm going to be running through with you guys my 6-point strategy that I use on any stock before I make entry. So I've been applying out there in the market to help my team over the Discord make hundreds of thousands of dollars last month alone. You heard me right. Speaking of that, this is one of the plays that we made entry today over the Discord. So we know the markets are rocky today. Plays are under heat. Prices are coming down. Check this one out. This one started the day at $58. Then we saw it pull back to 57, then 56, before finally bottoming out at $55. We caught the dip right there. Check what happened after that. Play made this rebound. We made the returns on the way back up. So if you haven't already, make sure you're hitting that top link in the description, tapping into our Discord so you get up on the plays and the moves that we make. I look forward to welcoming you over there. As I say, in this drop, we are tearing up a play. We're about to have a blast. So before I jump into it, make sure you guys hit that like button for me. Let's jump into the stock. So we are going to put ticker symbol FCEL, that's fuel cell energy, on the chopping block because I've seen YouTubers out there in the market telling their audience they should be getting into the play right now. So we're going to see if they pass my test. Remember, I've got 6 hurdles for any stock to get over to make it a good investment. To give you guys a bit of a flavor of the play, check out that 1-year stock price. We've seen this one spike up to almost $30 back in February. Now they're standing at $5. So let's get to it. First hurdle they need to get over is the revenue test. We want to be seeing plays that have consistent levels of revenue growth over the last 5 years, and particularly I want to see some near-term revenue growth. So that's revenue growth over the last couple of quarters. Now, why is that important? Because remember, we're trying to invest into plays that are showing high levels of performance, that are showing the ability to continue growing and scaling. That is what's going to make us money over the long term. Now check this out, all right? We're going to go through the annual revenue on this play. So if we check out their annual revenues, 2018 down year on year 6%, 2019 down 32%, 2020 up 16%. So a slight jump up, but I told you guys I want to see some near-term revenues. I want to see what the business is doing closer to date. All right, so let's check out the quarterly financials. July, this one year-on-year change down 17%, up 53% October 2020. Very next quarter down 8%, next quarter down 26%. So right now it's looking pretty disastrous for fuel cell when it comes to their revenues. They've already failed the first hurdle. The second one, guys, is again, I want to see some consistent net income growth. That's super important because investors care about that earnings per share. That's like the headline figure that you guys will see in any annual or quarterly report, and investors put a lot of weighting on that value because it shows what you are getting for every share. To even get an earnings per share number, you need some net income. So we want to see consistent levels of net income, or at least if they're not making net income now, we want to see a path to profitability. That is super important. So let's dive into it, see what they've been doing over the last couple of quarters as it relates to their net income. July, negative 15 million net income. October, negative 18 million net income. Check out the January, guys, negative 45 million net income. April again, negative 18 million. So on average, every single quarter, the business is losing about $20 million. Now, this again has devastating impacts for the overall business because for them to continue operating, they're going to need to plug that cash deficit from elsewhere. And you guys are going to see where they're getting that cash from and how it impacts that overall business. Let's get to the next one. All right, guys, so third is that we want to see that the play has improving levels of operating free cash flow. That is the cash that they are generating from the business. Now check this, 2019, operating free cash flow negative 30 million, 2020 negative 36 million, trailing last 12 months that is negative $63 million. So the business right now is just consuming cash like no man's business. We need to check out the balance sheet. Number 4 on the list is we need to see that they have got consistent levels of debt, or they're paying off their debt. We don't want debt skyrocketing in a business. This is because, remember, they're going to pay interest on that debt. That just has a burden on their overall business, because whatever they're making, they got high levels of interest payments as well, again affecting their cash and the overall structure and performance of the business. So check this out. They had 89 million of debt on the balance sheet in 2018. This jumped up to $112 million in 2019. Then we saw it skyrocket to $182 million in 2020. So right now the business is just piling on debt to their balance sheet. That's where they're getting some of the cash they need to continue operating their business. It doesn't stop there though. I want you guys to pay attention to the ordinary shares number with me. It's important that you guys aren't in plays are consistently issuing shares, because what they're doing is they're diluting the existing shareholder base, making your shares worth less. So you used to own this much of the company, they issue more shares, you own this much. They issue more shares, you own this much, and so on and so forth. So check this. Ordinary shares number in 2018 coming in at 7 million. 2019 coming in at 193 million. I'll say that again for you guys in case you missed it the first time. 2018 shares coming in at 7 million. 2019 numbers coming in at 193 million. Check this. 2020 issued again another 100 million shares, making it total of almost 300 million shares in the business. So they are just consistently diluting their shareholder base. What FCEL is doing right now is just killing their shareholders. You guys have seen me walk through this. Again, they failed on every single metric. But finally, we need to check the valuation of the play. That's super important. Now, to see if a stock is expensive, we need to take a look at the price to sales or the price to earnings. Remember, it's got nothing to do with the current stock price. So even though this one is a $5 stock, they can still be very expensive. Now, I've got a rule, guys. I like price to sales to be under 3 times unless it's a very good business with a good business model and good fundamentals, or a tech play, then under 10 times. So right now, this one's got a price to sales of 28 times. I'll let that sink in for you guys. Bearing in mind, I like plays with good fundamentals to be under 10 times. This one is triple that amount. So we got to play with bad fundamentals at an extreme price. This one just seems like daylight robbery for those who are investing in the play. That's why it's important to do these tests on the play so that you guys know you are getting value for money. The best setup you can have is a play with great fundamentals but at a good price point. When you get the two together, when you mesh those two, that is a recipe for success and you're going to make tons of money. Now, the purpose of me running you guys through this is that you can identify red flags in stocks and ensure that you're only in winning plays. But I already know I'm going to get a bunch of questions from those of you who've been put into this play or similar types of plays. When you guys know, as things stand, you are in what we call dead weights. As we go forward, it looks like the situation is going to get worse given the velocity at which they're adding debt, they're issuing shares, the negative cash balance, and that extreme valuation. Things could get worse. That stock price could come down. So instead of you guys being in this play and finding out 12 months later it's been split in half again, it's now a $3 play, you have the opportunity to pivot. Now remember, you can write off this loss with your gains elsewhere, but just know that if you're moving in winning lanes, you can make back that money in 6, 12, 24 months time, depending on how much you're down in that particular play. The stock market is a vehicle to make a lot of money. As I say, if you're moving in winning lanes, just know you have options. You don't have to remain in this play or other plays, I say, with this same kind of construct. Alright guys, so that wraps up for this one. If you got questions, drop them down below and I'll get back to you. As always, like that comment section on your way out. If you're new, join the movement and I'll catch you on the next one.